Hello and welcome to a discussion on accounting. Today we'll try to understand the cash flows. Why cash flows are important, maybe one of the important questions with which we can start our discussion. We know that profit, which is a result of the generally accepted accounting principle or is based on the preparation using the GAAP, is subject to various assumptions called accounting assumptions. So profit can be managed by managing the accounting assumptions, but the cash is not subject to the accounting assumptions. So it is often been said that profit is surreal but cash is real. So many analysts take cash to value the firm, to understand the strength of the firm, to understand the effectiveness with which the business is being managed. Therefore, understanding cash flows is important. In this session, we will try to have an answer few questions. What is cash in hand? Why is cash in hand not same as profit? And why is cash from operations not same as profit? And this we will try to answer by picking up a question where we have an opening balance sheet given which has some sources and the corresponding assets, and with this opening balance sheet there are certain transactions, and we will first try to convert these transactions into financial statements and then understand the cash flows in detail. So let us convert these transactions into financial statement. Sold 50% of the goods for 200,000 on credit. Before that, let us put the opening cash in hand in the cash flow statement. So sold goods, so sales is 200,000 and sales is not on cash, so therefore in the cash flow it is 0, but the debtors will increase to the extent of the credit sales. So debtors go up to the extent of 200,000. Whenever there is a sale, there has to be cost of goods sold because of the matching principle, and that is 50% of the goods sold, which is given here, 50% of the goods. So COGS is an expense, and the cost of goods sold reduces the stock, and stock comes down to 65,000. Stock comes down to 65,000. Depreciation for the period is 12.5% on the original cost of the asset, which is 200,000, so 0.125. As a result, accumulated depreciation goes up to 75,000, and the cost of the plant remains same because no asset was sold. Salary paid during the period 10,000, and the salary paid is an expense and outflow of cash. Rent paid during the period is 20,000, so the rent is an outflow of cash and an expense. Dividend, the company Z declared 50% dividend because Z is a company in which our company has invested, so the dividend received is 50% of the shares that you have, and the 50% of dividend is 25,000, and dividend is an inflow of cash, so it will be recorded as a receipt. Collection from the old debtors 75,000, so old debtors 65,000 into 75%, 48,750. It's not an income but the reduction of the assets, and here the reduction of asset happens in debtors. So debtors go down to the extent of 48,000. So the change in the debtor is because of the sales collection and the cash sales, which is 0 here. Paid to the creditor 100%, 100% creditors, so the previous creditors we paid, but this payment is not an expense but is a reduction in the liability. So some payments may result in an expense, some payments may result in the reduction in the liability. Purchased goods, purchased 1000 bonds of 100 each at the face value. So purchase of bonds is 10,000, is an acquisition of asset, is not an expense but acquisition of asset, and asset goes up in the form of bonds 10,000. Since all transactions are done, we will put the interest for the period is 10% because of the accrual concept, and interest is an outflow of money, so interest is shown as an expense and also an outflow. Now let us find the summation of expenses, 130. So profit before tax is 225 minus 130 that is 225 minus 130, so 95,000 is a profit before tax, and let us assume the tax to be 30%, so therefore tax is equal to 0.30, and let us also assume the tax has been paid, so it is an outflow. So after tax, profit after tax 66,500 is the profit after tax. If no information is given, we can retain the entire profit and transfer the profit to the balance sheet. Now we can find the cash in hand. Cash in hand is the cash available minus the total cash payments, okay, minus the total cash payments, which is 128,000. So the cash in hand is 95,250, and 95,150 will appear on the balance sheet. No other transactions. So during this period, no change in the capital, no change in the loan. So the total sources is now 616,500. No change in the bond shares. So the total assets on that day is 616,500. So we have converted the transactions into the balance sheet, income statement and cash flow. But we have questions. The cash in hand therefore is the receipts plus opening minus all payments. We underline minus all payments. The second question is, why is cash in hand not same as profit? Cash in hand is 95,250, where the profit is 66,500. Profit is incomes minus expenses, whereas the cash in hand is receipts minus payment. Every receipt is not an income. Every income is not a receipt. Every payment is not an expense, and every expense is not a payment. Therefore, profit is not equal to cash in hand. And the third question is, why is cash from operations not same as profit? To do that, let us first find the cash from operation. Cash from operation is a receipts from sale plus collection minus salary minus rent minus creditor minus the tax. So cash from operation in this case is negative 59,750. Cash from financing is a result of financing decisions. No cash from financing inflow. There is only outflow. The outflow is interest. So therefore the cash from financing is also negative, that is 10,000. Cash from investment is a dividend received minus the bonds, so it is 15,000 cash from investment decision. So cash from investment, cash from financing and cash from operation is reclassifying the receipts and payments on the basis of the operations, the financing and investment decision. So the question is, when the company is having a PAT of 66,500, how come there is a negative CFO? In order to do that, let us reconcile the profit with CFO, which is called an indirect method of determining CFO, which will answer why is profit not same as PAT. Profit is not same as CFO because of non-cash items, because of non-operating items, and because of the changes in the working capital. So non-cash item is depreciation, non-operating item is interest, non-operating item is also dividend. And the changes in a working capital, you can see that the working capital, the creditors have decreased, so that means you paid money for that. The debtors have increased, that means we sold the goods on credit. The stock purchased in the last period has been sold in the current period, so we have not purchased anything during this period. So if our summation add all these things, we get the CFO, which is 59,750 negative. So CFO is 59,000, PAT is 66,500. They are not same because of non-cash items, because of non-operating items, and because of the credit items. So it is possible that a company may have a huge profit after tax but a continuous negative CFO. So as an analyst, it is not enough to understand that there is a profit. It is necessary to understand, is the company is having the CFO? If not, why is the company not having CFO? In this case, though the company is making profits, it is not able to generate the cash because there is a huge credit sales and there is a huge payment to the creditor. So managing this business is to understand that the necessary for the company to convert the profit into CFOs. Thank you very much.